The global foreign exchange market is entering a period of heightened volatility driven by diverging central bank policies, geopolitical instability, and shifting commodity prices. Here's what matters now. The U.S. dollar remains relatively strong, supported by the Federal Reserve's cautious stance. While inflation is cooling, the Fed is hesitant to cut rates too quickly, maintaining the USD's appeal as a yield-bearing safe haven. However, this strength is being challenged by growing fiscal concerns and rising Treasury issuance, which could pressure the dollar later this year. In contrast, the euro is underperforming due to signs of economic stagnation in the Eurozone. The European Central Bank has already begun cutting rates, signaling a divergence from the Fed that could push euro to U.S. dollar lower in the near term. Energy dependency and weaker German manufacturing data also weigh heavily on euro sentiment. The Japanese yen continues to struggle as the Bank of Japan remains ultra-loose on policy despite rising inflation. Carry trades remain attractive, and unless the BOJ intervenes or shifts tone, U.S. dollar to Japanese yen may remain elevated, testing 160 levels again. Commodity currencies like the Australian and Canadian dollars are facing mixed pressures. Australia is closely tied to China, and weaker Chinese growth data puts AUD under pressure. The Canadian dollar, though, could benefit from rising oil prices amid Middle East tensions and a resilient domestic economy. Emerging market currencies are experiencing pressure from a strong dollar and global risk aversion. However, some countries with high real interest rates and current account surpluses, like Mexico and Brazil, are holding up better than peers. Gold and oil remain key drivers. Gold's near-record level suggests that investor caution is rising, while oil prices are volatile due to OPEC plus decisions and geopolitical risk, impacting energy-dependent currencies. Overall, the Forex market is highly sensitive to inflation surprises, central bank signals, and political instability. Traders should watch the macro indicators closely. CPI prints, central bank speeches, and geopolitical headlines are setting the tone for currency flows in the months ahead. Sources and description.